Hello and good afternoon, everyone. Thank you for joining us. We are here to discuss the financial relief options that are available to small businesses under the various phases of coronavirus relief legislation that has come about in the last few weeks. On our panel, we have Gopal, Burgher, we have Gaurav, and we have Christopher. Just to give you a brief introduction, Gopal is our managing partner at BurgherGray. He has advised clients on various kinds of loan transactions, and he has extensive finance experience. Gaurav is an experienced government affairs leader. He has drafted various emergency bills at Capitol Hill, and he has worked as a trade association executive for about 8 years. Chris is our tax partner. He has advised on tax aspects of many transactions, and he's also a tax professor at Siena College. On to you, Gopal, Gaurav, and Chris.
Gaurav, were you going to do the overview or?
Sure. Matt, why don't you put the presentation up and we'll get started here. If you could. This presentation on the coronavirus relief programs that Congress has passed. We've got a fairly robust sort of outline here of all the different programs, everything that's available and eligible to small business owners to be able to help them get through this really, really tough time. What you're seeing on your screen now is the 3 loan programs that are available, the Paycheck Protection Program and the Economic Injury Disaster Loan Program. These 2 loan programs were created or modified as part of the CARES Act to help small business owners get through this difficult time. There are a couple differences between these programs, and we'll walk through each of them as we go forward here. You've already met, Shubra's already introduced the BurgherGray team that is your panelist here. You've got Gopal Burgher, who's our managing director, and many of you may know or may have worked with at some point. You've got Chris Klug, who's our tax attorney here and tax partner, and is really just brilliant when it comes to all matters tax and financial planning. And then you've got myself, who has been a lobbyist with the federal, who has been lobbying the federal government for over 15 years and has helped write these bills during the financial crisis of 2008, 2009. And I've been greatly involved with Capitol Hill in how these programs have evolved and developed over the last couple of weeks and what's been going on with the 3 programs put on by the SBA and by Congress. So if we can go forward 2 slides, Nick, please. So this is this Small Business Act 7A, to get into the legal terminology of it here, has created the EIDL loan program and the Paycheck Protection Program. As you can see here, the 2 columns that are going to be most relevant to most businesses are the EIDL program and the Paycheck Protection Program. The Economic Bridge Loan Program really only helps if you already have a pre-existing relationship with the Small Business Administration, and won't be utilized by most people looking for advice on what to do to work through these things. So I'm going to turn over to Chris, who's going to talk a little bit about the application criteria for each of these programs. If you want to go to the next slide, Matt.
Yeah, so for I'll start with the Express Bridge Loan Program. As Gaurav mentioned, the idea is to get companies these loans as soon as possible. So therefore, there shouldn't be a need for the bridge loan, because I want to approve you for the EIDLP program, which is the Economic Injury Distress Loan Program. And so they expect you to take what they have to start with a $10,000 grant and be able to get the $2 million loan approved fairly quickly. So you get a $10,000 grant, supposedly within 3 business days of applying. We're hearing that it takes a little longer. And then you're supposed to get the $2 million, well, the amount of the loan they approve you for fairly quickly, so there shouldn't be a need for a bridge loan. But if a bridge loan is needed, you can get up to $25,000, and the goal is that the bridge loan can hold you over until your EIDLP application is approved, which can allow a loan up to $2 million. Your $25,000 bridge loan would be rolled into that loan, and then I'll let Gopal highlight the PPP program.
So with respect to the PPP, this will be available to sole proprietors, independent contractors, and self-employed individuals. Although I should note that these applicants will attract a higher level of scrutiny as this thing is being played out. It's also available to any business, 501c3 not-for-profit organizations, veterans organizations, or tribal business concerns. And each of the above, in order to qualify, will have to have been in operation as of February 15, 2020. Will have to have suffered significant disruption as a result of COVID, but I think that one is pretty much being taken for granted. Not much to demonstrate there other than to certify that is in fact the case. And lastly, I lost my place in the slide here. And you have to have been in existence as of February 15th, as noted. You have to have you have to have had salaried employees as of that time for which you were paying payroll taxes, and you have to have 500 or less employees, or in certain limited cases, meet SBA's industry-based size standard as an alternative. In addition, businesses in the accommodation and food services industry can also exceed the 500 employee criteria if they otherwise meet certain criteria.
Okay, and I'll quickly run through the EIDLP eligibility again, which is the Economic Injury Disaster Loan Program. You have to be, again, you have to have 500 employees or less for the most part for companies. In this one, you have to show substantial economic injury as a result of the COVID-19 crisis. For this program, you're gonna have to. It's not as automatic. I guess I won't say PPP is automatic, but you're gonna have to show how it's hurt your business, provide some financials and forecasts, and then as far as the bridge loan, that's a $25,000 loan. Like Gaurav said, you had to have a relationship with an SBA lender that can make these types of loans. And this application is not supposed to have the same documentation as the EIDLP. Goal is to get a bridge loan out there of up to $25,000. And I think we can go to the next slide.
Not update. Did the slide change? There we go.
All right. And then for this one, can an immigrant-owned business qualify for these loan programs? And the EIDLP and the Express Bridge Loan both follow the traditional loan program requirements. So non-residents or people in the U.S. on green cards that own businesses can qualify for these loan programs. It's going to be up to the lender, the SBA lender, whether they want to make a loan. I mean, these loans aren't automatic to begin with, but there are certain qualifications. The business had to be in operations for a minimum of 12 months, and they'll need to personally guarantee the loan. And so the business owner doesn't take off and leave the country. They need enough U.S.-based collateral to ensure repayment of the loan. And for the PPP program, at first there was some confusion because the initial application said that the owner or required the owner to certify they were either a U.S. citizen or a permanent resident of the U.S. In an updated application that was removed, the programs are much more based on employees working in the U.S. for a principal U.S.-based business. Again, the goal of these programs are to keep people working, keep businesses afloat that are struggling during these times. Go to the next slide. So typically when you do an SBA loan.
So Chris, can I jump in here for a second? So people are seeing 4 columns on their screens, and one of them is the traditional loan program that you notice we're not talking about very much, and we included here as a frame of reference of what would typically be the case in terms of an SBA loan. An SBA loan in other than crisis situations, but we thought it'd be helpful as a frame of reference. But in the interest of time, we're not going to focus a lot of our discussion on it. So if you're wondering why we have 4 columns and we're only really talking about 3 programs, that's the explanation.
Okay. And typically to get an SBA loan, you have to prove that you're not able to get credit elsewhere, and that's a requirement to get the loans. Under the EIDLP, which is the loan program up to $2 million, you do not need to prove that you can't get credit elsewhere. Same with the Paycheck Protection Program. There's no requirement to prove you can't get credit elsewhere. But under the Excess Bridge Loan Program, you do need to verify that that requirement is met. And further, the business's FICO score has to be at least 130. So, and again, that kind of goes along with you have to have a relationship with the bank. So the SBA lender has to have a relationship with you. And I don't know why a $25,000 loan has more requirements than a $2 million, but it's a loan that's been in place prior. So I don't know why, but that's how it is. Go to the next slide.
So for this part, right, there's going to be lots of questions on, do I have to have good credit? Do I have to be credit worthy? How does this all work? For the EIDL, the credit score or alternative appropriate methods are taken into account here. One of the most interesting things about this is the SBA has lowered the credit score applicability to anyone over a 620. So they've dropped their average credit score, the willingness of the range they're going to down to 620. Furthermore, if you can, there's some even more leeway. What we're hearing out of SBA is that if you have a lower credit score than that, you may still be able to get an EIDL. It's just not as guaranteed, so to speak. For the PPP, you still have the same typical criteria of creditworthiness and repayment ability, but that's been eliminated. Now, what we've seen and what we're experiencing from applications is that banks are looking for you to document and be able to prove what you're going to be able to use these loans for. So because the creditworthiness and the repayment ability has been eliminated, they're going to extra levels of scrutiny to ensure that your loan will be forgiven, or that the expenses and borrowing amount would qualify for forgiveness in order not to have a high risk loan on their books. And then for the bridge loans, credit scores, tax transcripts, all that stuff are going to be used. You already have those things. If you already have a working relationship with an SBA lender and you've got an SBA loan, then the bridge loan will just be an extension of that. And everything you've already got through the working relationship will just be continually capitalized on and used. So that's everything on the credit.
Hey, Gaurav, on the PPP, on the PPP side, I would also note that one of the things that some banks are doing to mitigate credit risk and do an end run around the fact that they can't ask you for the typical credit support documents is they're requiring that you because these loans you apply directly through your bank for these loans, and as opposed to directly with the SBA. So some banks are requiring you to have pre-existing relationships with the bank,
yes.
Credit relationships. And so that's one way of ensuring that they already have some credit-based information on you. So you may be required not only to have a business account with the bank, but also a lending relationship. So bear that in mind as you approach your financial institution. This is not an SBA requirement, but the banks are allowed to impose these additional criteria for processing a loan through that institution.
Yeah, very good point, Gopal. That is correct. The banks, because these loans are so cheap, want to ensure that they minimize their risk and exposure, and SBA has allowed them the ability to do that by not giving them parameters on any other additional restrictions that the banks may wish to impose, as long as the banks do not do it off of credit score, creditworthiness, sort of, and ability to repay. The banks are able to do other things like pre-existing relationships and things of that nature. We can go to the next slide. So loan combinations. This has been a much maligned and talked about topic here in Washington, D.C. If I apply for a EIDL loan, can I also get a PPP loan? The short answer is yes. The longer answer is it's complicated and there are financial conversions and things that need to be done. Currently, EIDL loans, and we'll get into forgivability in a second, EIDL loans are not 100% forgivable. Portions of the EIDL loans are potentially forgivable. In true sort of government and lawyer speak, you have to use all these qualifying pieces of language of up to and potentially, because of the way these programs are administered, and specifically EIDL, parts of it, depending on how you use the loan money and what it pays for, may be eligible for SBA loan forgiveness. The EBL loan, you can get one bridge loan, but it has to be contingent on you having applied for an EIDL or a PPP loan already, and you're in a intermittent window of waiting for them to fund, and you have an existing loan or an existing SBA lender relationship. What's interesting is both the EIDL and the PPP loan state in their applications that if you have an existing SBA 7A loan, you cannot apply for an EIDL or a PPP loan. You're supposed to use the bridge loan as the funding vehicle off existing SBA loans. And then, so the real combination and the applicability for combinations for the two, or for the three, is you've applied for an EIDL, you're waiting for funding, you can apply for an EBL, and then once the PPP loan funds, your EBL and EIDL would essentially, for lack of a better term, and this isn't the way it's actually done on the back end, but for the easiest understanding for the public, your EIDL and EBL would be refinanced using your final PPP loan. Now, in some instances, your EIDL may be a larger loan. The EIDL program has a cap of $2 million, and EIDL loans can be used for working capital. Since EIDL loans can be used for working capital where PPP loans cannot, they can only be used for payroll, rent/mortgage interest, and utilities. It may be advantageous for a business to take out both an EIDL loan and a PPP loan, get the forgivability under the PPP loan of the payroll, mortgage interest/rent, and utilities, and then use the EIDL loan to pay working capital, distributors, short-term debt, things of that nature. The interoperability and interchangeability of these programs leads me to recommend all of my clients and all of our clients at BurgherGray here to really consult with both your tax advisor, your financial advisor, and your attorney to make sure you are using these programs properly and correctly, and you're also applying for the right programs to maximize your benefit. The PPP loan program may be 1% interest for 2 years, but the EIDL loan program is only 3.75% interest for up to 30 years, meaning you can get some really cheap capital for working capital purposes long term. We'll get into more of that as we go into the following slides, but the short answer to this question here is, are they combinable? Yes, with an asterisk of how you do it and that you do it appropriately and correctly. Next slide. So going into loan amounts, Chris, do you want to cover sort of the maximums and the loan calculations?
Yes. So under the EIDL, the maximum loan you can get is $2 million. Upon applying, the borrower can request a $10,000 grant. Essentially, if the loan is not approved, they don't have to pay back the $10,000. It would be reduced against the PPP amount of what can be forgiven later on if the EIDL loan is denied. The excess bridge loan, the maximum amount that can be taken out under that is $25,000. And for the PPP, I don't know, Gopal, do you want to go through the PPP calculation?
Sure. In short, it's going to be 2.5 times, or the lesser of 2.5 times your average monthly payroll, or $10 million. So 2.5 times your monthly payroll, your average monthly payroll, up to $10 million. And for calculating your average monthly payroll, for the average applicant, it will be your average monthly payroll for calendar year 2019. There are some exceptions. If you're like a seasonal business and so forth, you can use some alternate calculation. But for now, let's just stick to the category that the vast majority of people will fall into, which will be your average monthly payroll for 2019. You cannot count the portion of any employee's salary over $100,000 in that calculation. You also cannot count compensation paid to non-U.S. Based employees. And you cannot include in that calculation compensation paid to independent contractors. I know that's been a source of uncertainty and in some cases confusion, but it's now been clarified that compensation paid to independent contractors cannot be included in the calculation. It's a gross calculation, so you need not exclude employee side payroll taxes and deductions, but employer side taxes are not included in that also.
So Paul, how about someone that's sole proprietor or they have self-employment income? Do they get any benefit out of this program?
Yes, as I indicated a couple of slides earlier, sole proprietors and independent contractors are in fact eligible for funding under this program. And one of the reasons why you cannot include compensation paid to independent contractors in the computation of the loan amount here is because independent contractors are separately able to apply for themselves, and they would use the compensation paid to them for calculation of their loan amount.
Right. And on top of that, I would recommend that independent contractors apply for both the EIDL and the PPP. The SBA has issued some guidance saying that more likely than not, they're going to focus the grant money, that $10,000, on sole proprietors and independent contractors, and the PPP will focus on the actual small businesses. And that's sort of their plan and direction right now. There's been a lot of issues with the way, because banks are unwilling or have not been as open to working with everybody on these programs. Some banks are limiting how much they will lend out under PPP. It makes it very difficult for sole proprietors to get into that bank's queue if you don't have a long established banking history with that bank. So I would recommend, if you're a sole proprietor with no or an independent contractor with no employee payroll, apply for both programs. Know that you're more likely to get approved under the EIDL than you are the PPP.
And the other thing to note here about independent contractors and sole proprietors, it is apparently a big concern of the SBA that a lot of fraud potential exists here with independent contractors and sole proprietors, and so you should expect a higher level of scrutiny if you're a sole proprietor or independent contractor applying for one or more of these loan programs, and that's just the reality of it.
All right, let's move to the next slide. And I think we covered this through our conversation back and forth, so we can move to the next one as well. All right. So, go ahead.
You want to cover the interest rates, or?
Yeah, go ahead.
Sure. Just a real quick overview on the interest rates. We know we've mentioned this a couple times already. I know Gopal mentioned it about the PPP program. The interest rates are fixed, right? So the EIDL is not to exceed 3.75%, and the PPP program is fixed at 1%. The bridge loan has a maximum allowance of 6.5% over the prime rate. That is the only one that will fluctuate, is the bridge loan. But again, most businesses aren't going to be considering the bridge loan unless you have an already existing SBA lending relationship and you're working through that. Either way, the interest rates are low enough on these where the capital through both programs or all three programs is cheap, and is cheaper than other private forms of debt capital that you could get.
Okay, next slide.
And just to build off the interest rates, the maturity or the term lengths, the EIDL program is similar to a mortgage. These are really, really long-term loans, which means, the idea of the EIDL program is it existed before this whole thing happened. The EIDL program existed to help businesses after hurricanes, after earthquakes, after other natural disasters. And so they wanted to make sure that any debt or any loan that a small business took on would be easily repayable, and that the monthly debt burden or the monthly minimum payment wouldn't be such a huge burden that the business couldn't handle it. So the EIDL loans go up to 30 years, up to 30 years. While the PPP loans are meant to just be used, the PPP program is about the next 8 weeks. That's all it's about, is funding the next 8 weeks and covering the payroll for the next 8 weeks. So the loans are only really set to be repaid over 2 years, because what they're expecting is for you to use the PPP loan to pay your payroll for the 8 weeks after origination. So you really shouldn't have anything to repay over the 2 years, because your loan, if you use it correctly, if you use it correctly, is the key words here, should be 100% forgiven by the federal government. And that's why the loan term is only up to 2 years. And then the bridge loan, again, has a 7-year maximum. It's structured, and that'll be independent between you and the lender you're using. Next slide. So, debt forgiveness. I think this is the biggest absolute question that people have when we talk about these programs is, what can I get forgiven? Under the EIDL, I know it says non-applicable here, but as Chris mentioned, there's a $10,000 grant that can be forgiven if, and this is a big if your EIDL is denied, right? If that application is denied and you don't get the EIDL, then your loan will be, your $10,000 grant will be forgiven. That's the only forgiveness. There's no forgiveness under the bridge loan program, and under the PPP program, there's forgiveness, and this is that 8-week period I talked about. That 8-week period is from the day the money goes into your bank account, from loan origination date. During that 8-week period, you need to keep receipts and proof of all your rent, all your payroll costs, your mortgage interest, and all your utilities. Those costs will be forgiven. So say your loan is $100,000 and your rent cost, your payroll cost, your interest on any mortgage you own, and your utility payments equal $100,000, you will not have to repay that loan. The federal government will pick up the tab.
Yeah, it's important to point out one thing.
Gaurav, question for you. What if you are an applicant who has gotten a loan and you're thinking about loan forgiveness? Is there a certain percentage of your loan proceeds that have to be spent on, say, for example, payroll in order to get 100% forgiveness?
Absolutely. That is an excellent question, Gopal. And that is one of the caveats to get 100% forgiveness. That first caveat is that your payroll, the loan, 75% of the loan must be used for payroll. If under 75% of the loan is not used for payroll, there is some nebulous sliding scale. The government will determine it on a case-by-case basis of the amount of forgiveness you will actually get. It could be 0, it could be 99%. There is no clarity, there is no guidance on that. Just know that if you use more than 25% for non-payroll, you are going to have to go 10 rounds with the federal government to get your loan forgiven. And so we would recommend making sure 75% of your loan size is used for payroll forgiveness. There's a second caveat on this. You cannot, for that 8-week period, reduce your payroll below 75% of where it was when you applied. So if you applied saying your monthly payroll was $100,000 a month, then you can't lower your monthly payroll below $75,000 a month. If you lower your payroll below $75,000, or if you lower your payroll more than 75% of your normal monthly payroll during that 8-week period, you will also get dinged. We don't know how much. We don't know what the reduction in forgiveness will be, but there will be a reduction in forgiveness.
And Gaurav and Gopal, either of you who might know, do we have any guidance for the lender who has to verify this? Rent is typically paid once a month, so only one rent payment may come up during that 8-week period. Maybe payroll, it might cut out half of your payroll week because you pay it biweekly. Are they going to prorate costs, or are they going to stick strictly to see what they see on paper for that 8-week period?
I don't know that there is any specific guidance on that, Chris, but what I would expect is that if you have enough payroll expenses to get to 75%, you'll get credit for that and before they start to prorate anything. That's what I would expect.
Okay. Hopefully, there's some kind of reasonableness with it that they will, look at expenses that are accrued and not just what they see on paper.
I would imagine that if you were behind in your rent payment, I don't know, a couple of months or whatever before you got your loan, or even before February 15th, that if you were to use the loan proceeds to cover not just the current rent but your arrears, you should be okay. I mean, technically, you would be within the parameters of having spent the funds on a permissible purpose, which is to pay rent. Nothing in the guidance so far has specifically said it has to be rent that's accrued between February 15th and say whatever the 8-week period end date is. And one further clarification too on this point, the measurement date from when for measuring whether you have payroll reduction would be as of February 15th. So they'd be looking at whether your payroll has been reduced from what it was as of February 15th, which is the beginning of the covered period.
Okay, very good. Let's move to the next slide. All right, and the next question is, does the company have to have any collateral in order to get these loans? For the PPP, no collateral is required. The same for the excess bridge loan, but under the EIDL loan, there has to be collateral for loans over $25,000.
Right, and the reason for that is, again, the EIDL loan is the primary target of, if you're a sole proprietor or independent contractor, that's where they're trying to push everyone. And that's a sole proprietor or independent contractor. And so that's why they're requiring collateral over $25,000.
Next slide.
So the personal guarantee, and this is similar, similar because of the programs and the way they're set up. If you have a loan, an EIDL loan over $200,000, there will be a personal guarantee, which means the federal government can come after you to recoup any default, and can come after your personal property to recoup on any default that you may file on that loan if the loan size is over $200,000. The personal guarantee is waived for loans under $200,000, but remains intact for the ones over. And that personal guarantee will extend for a loan over $200,000 through the EIDL program. That personal guarantee will extend to anyone who owns more than 20%.
Or 20% or more.
Or more, yeah. And then for the PPP, there is no personal guarantee. And again, that is out of the design of the program, because they're literally requiring you to use 75% of it for payroll, not diminishing your payroll. They've set so many parameters on the forgiveness side. And because the size of the loan is only 2.5 times your monthly payroll, there is no personal guarantee, because they know where the money is going to go, or they feel very confident and in control of where the money is going to go. And they're not requiring the personal guarantee. Next slide. Gopal, do you want to cover what the SBA guarantees for the lenders?
Sure. The SBA guarantee is distinct from the personal guarantee that's provided by owners for the benefit of the SBA. The SBA guarantee is basically the guarantee extended by the SBA to the participating banks to say, hey, if you, the borrower, defaults on any of these loans, the SBA will cover repayment of up to 85% of the loan amount for EIDLP loans, 50% on the EBL, and this is what makes the PPP particularly attractive. They will cover 100% of the exposure on the PPP loans, which obviously was designed to incentivize banks to participate on a wide basis, since if all goes well, in terms of them complying with all of the criteria applicable to lenders, they will have no exposure here because the SBA will step in, cover 100% in the event of a default by you, the borrower, under this program.
Excellent. Thanks, Gopal. Next slide, please. So this is where we get into the daunting part of the application process. The EIDL, and I'm going to cover the EIDL, and I'll let Chris talk about the EBL, and Gopal will cover the PPP. The EIDL application, it takes about 7 minutes, and I kid you not, it takes about 7 minutes to apply for this thing. It's 3 pages. It's a self-certified application, and the website is covid19relief.sba.gov. That will take you to the application. You answer your questions. You self-certify. You select yes, you would like the $10,000 advance if you want it, and then you wait. After probably about a week-long period, about 5 to 7 days, a SBA loan officer, that means not a banker, but someone who works for the federal government, will be in touch with you to get more information for your EIDL loan. That'll probably take another week to 14 days after they collect that information. You will get your determination for the size of your EIDL loan, and then your EIDL loan will be processed and paid, or originated to you, so to speak. That's the process for the EIDL loans. We have seen the grants have not really been paid yet. No one's received their grants yet that we've talked to. They are probably, my last conversation with the Small Business Administration said that grants will most likely start going out tomorrow and probably finish going out on Monday or Tuesday. So in government speak, I'm imagining that probably Wednesday, Thursday, Friday of next week is when this will all actually happen. But that's our best guess. That's the best we can do right now, is sort of throw darts at the dartboard for when the EIDL funds will come out. I know the reason for the delay has been because of the fraud and the abuse and the waste in the application process. So they're checking to make sure that people truly are sole proprietors and that people aren't just applying and getting the money for free.
For the Express Bridge loan, again, you have to have that relationship with the small business or Express business lender that can make the loan, and that relationship must have existed before March 13th, 2020. If you meet that criteria, you just have to have the loan approved by March 13th, 2021. Like Gaurav said, probably not a lot of people will be using this program as much because the EIDL application should be accepted so quickly. But in order to apply, you have to have a small business scoring service score of a minimum of 130. Do the personal credit scores for each owner that needs to provide that information. You have to fill out a form with the that allows them to, from the IRS, to grab your tax transcript to make sure there's no outstanding tax issues. And then you have to be able to document your relationship with that business and do that through a bank statement.
On the PPP side, as mentioned before, you would apply for this loan through your bank as opposed to directly with the SBA. The application, you must get your application in by June 30th. the loan could be funded after that, but your application has to be in by June 30th. So important deadline there to keep in mind. And I would say that, if you're planning to apply sooner rather than later, is probably the way to go. There's been speculation that these programs will run out of funding, before the actual final dates to apply. So, and it's all on a first come, first served basis. So, the president has indicated that, if necessary, he would ask Congress for additional funds, but there's no telling whether or not that will actually happen for a number of reasons, or whether Congress will actually appropriate additional funds. So I'd say, get in line as quickly as you can if it is your intention to apply for one or more of these programs.
Great. We've gotten a number of questions, which we certainly want to answer. See that we're running close to the scheduled time event, but maybe I'll hit the highlights of the tax advantages that came out of the CARES Act, and then we'll certainly move right on to the questions. So we can move to the next slide. So for the loans that are forgiven under the PPP, there's going to be no income tax consequences at the federal level. Typically, if debt's forgiven, that's subject to income tax at the federal level, and here it's not. If we move to the next slide. Then the question is, well, what happens at the state level? The way they made that loan forgiveness not being taxable didn't do it through the code section. So it could be subject to tax at the state level. I think Montana has come out and said they would not tax it, but you kind of have to look at it state by state. Let's move on to the next slide. All right, so there's this other big tax benefit called the employee retention credit. If you can qualify for the PPP, I can't see a reason you wouldn't do the PPP over this employee retention credit. So I think this credit's really for large employers, and what it does is it allows a payroll tax credit for 50% of the wages to eligible employers. The maximum amount per employee can't exceed $10,000. So since it's 50%, the maximum amount is $5,000 per employee. And so I think this is, and there's qualifications. Either has to be a business that's been affected directly by the coronavirus, such as commerce, travel, or group meetings, or your business has a 50% reduction in quarterly receipts. Next slide, please. So if the amount of wages that you can get a credit for exceeds your payroll taxes for the quarter, you can get a refund of that amount and get money in your account. Again, the goal is to get money in the account to keep employees. Next slide. And then there's another one. Again, you can't take this benefit if you applied for the PPP, but employers can delay payment of their 2020 payroll taxes starting as of March 27th through the end of the year. And the way it works is you don't pay the payroll taxes this year. You pay 50% of the amount that you deferred in 2020 at the end of 2021, and you pay the remaining 50% at the end of 2022. Next slide, please. And next slide. All right, I just want to highlight this, and this will be the last slide. There's changes under the 2017 Tax Cuts and Jobs Act to the ability for businesses to take net operating losses. First, it limited it to 80% of taxable income, and it eliminated the ability to carry net operating losses back to prior years. They have removed that for tax periods that start before 2021, so you can get 100% of the net operating losses against taxable income for periods before 2021. And they allow a 5-year carryback now, so you can go back to 2015 for losses occurred in 2020 if the business had profitable income in that year. One key is under the code, if there's a declared disaster, then you can pretend that those 2020 losses happened in 2019, thus allowing the carryback to go back to 2014. Another key thing to think about with net operating losses is that the tax rate in 2018 for corporations dropped from 35% to 21%. So if you can carry back those net operating losses for years starting before 2018, you can get 35 cents on the dollar refunded to you instead of 21 cents on the dollar. So that's a big benefit. Again, they're trying to get money to companies now, amend the tax returns, and re-employ people. So I think that concludes the presentation. Let's move to the questions.
All right, this is Kevin. We have a ton of questions here. I'm not so sure that we're going to be able to get through all of them. So one of the things that we could do is compile answers and send them out after this along with the PowerPoint, but we'll try to tackle as many of these questions as we can. All right.
So Kevin, I can actually answer a couple of these really quickly.
Okay, go ahead.
Nangolin and Gulo, you said, I'm a sole proprietor / independent contractor. If I want to get forgiveness of 75% of the loan, what would be included as salaries, the professional fees that I pay myself every month? Yeah. So what the bank is going to want to see is what, in this case, since you don't have a W-3 statement of you paying an employee, right? You have a Schedule C statement on your taxes. The bank's going to want to see that Schedule C statement of how much you made last year as part of the PPP application. And then that's what they will base your monthly payroll cost off of. And then when they figure out your monthly payroll cost, you can use 100% of the loan value to pay your payroll cost. And that will actually all be forgiven. Or you can use 75% to pay your payroll and 25% to pay your office space rent, your utilities, and that will still all be forgiven. So for sole proprietors, independent contractors applying for the PPP loan, the payroll calculation is basically what you made last year up to $100,000 maximum still. The next question, Rodney Doyle. If you're in business for just 1 year as a sole proprietor with no employees, are you saying that under the CARES Act, they would not be eligible for the PPP loans? Also, again, can you go over how to calculate the payroll cost? So Rodney, again, if you are a sole proprietor who has no employees, the payroll cost is calculated off of how much money you made and declared on your taxes last year.
And I think Rodney's question was he hasn't been in business for a year, so you would base it maybe 1099s. That'll be a difficult one to document if you're using January and February of 2020 if you're a sole proprietor.
Yeah, so what the banks are asking for in that case is the banks are honestly prorating. So they're saying if you've only been in existence for 2 months or you've only been in existence 3 months, then your payroll is calculated off of that, extrapolated over the course of a year, right? So whatever you made in those 3 months times figured out to say this is what it would have been for a year divided by 12 is your monthly payroll. And then any independent contractors who work for you would have to apply for their own PPP loans. They do not count as employees, and you cannot claim them as employees under the PPP program. Next question, Stacy Simon. Chris, maybe you want to talk about this a little bit. If you have multiple corporations, say a landlord has each building as a separate corporation, which program is best?
Well, again, you can apply to both the EIDL and the PPP and get benefits under both. So if you're in, my understanding, a lot of landlords have been heavily affected by what's going on because tenants are having trouble paying rents. That I think you'd apply for both program. As far as having multiple maybe companies underneath a corp, they look at affiliates and determining whether your size, you're a small employer. But I would certainly apply for both programs if under the EIDL you've suffered the substantial economic injury.
Yeah, and the EIDL also bases the size of the loan off of lost rent. The EIDL is actually again, because this program was designed for after hurricanes and other natural disasters, lost rent is actually one of the application questions. Lost rental income is actually one of the application questions on the EIDL application questionnaire. And so you can actually put that in there and be able to state that I've lost this much money. So while you may not be able to, look, if you're an independent landlord who owns 12 buildings all incorporated as separate corporations and you have no employees, you're not going to be able to get 10 forgivable loans. They're looking at the affiliation test, and they're going to look at who owns each of those each of those corporations that each of those buildings is in. So you need to sort of break that down and understand that what their net goal here and what SBA's net goal here is, what is the final end taxable entity that these revenues are going into? And that's where they're aiming for. So Stacy, yeah, again, I would apply for both. Under EIDL, you're likely to get a much larger loan because it can cover non-payroll. And when the PPP loan says it covers mortgage interest and rent, that is the mortgage interest and rent you pay to operate your business for your office space. That isn't the mortgage interest and rent that you've lost as income, right? Only the EIDL covers the mortgage interest, or will, through that loan program, cover mortgage interest or rent that you've lost through income. So that's important to know that sort of thing. And so, Stacy, I would, recommend reaching out to Gopal and Chris and myself and getting a private consultation that might better work for, us breaking down your lines of businesses and how we could structure a plan that makes it best for you. Paul McQuaid asked, for EIDL, is having your collateral tied to an existing line of credit going to be an issue? I don't know. Gopal, you have any light on that from the lender side, maybe?
Is having your collateral tied to an existing line of credit going to be an issue? Yes, because, it's going to be an issue in terms of what collateral you have available. If the collateral has already been pledged to another lender, then you typically won't have, the SBA won't have a first lien on that. However, I don't think that will preclude your eligibility for the loan under the EIDL, simply because your SBA will look at what collateral you have available, and they will basically try to work with your available collateral, and while also looking at the strength of your personal guarantee. So it will have an impact, but it won't necessarily result in denial, simply because you have a first lien to another lender on the collateral.
I just want to quickly note, we know we're at 3 o'clock already, but we're happy to stay on and continue to go through the questions. If you have to drop off, we understand, but we want to make sure we answer your questions.
Yeah, we'll run up until 3:15, the latest, which should give us enough time to do that.
So I'll keep going through some of these questions. Brian Idehen asked, what if you can't get all of your staff back, or they're making more on unemployment? Well, Brian, then I would recommend an EIDL loan, because your PPP loan is only going to get forgiveness if you maintain 75% of your payroll for the 8 weeks following the origination of your loan. So
and bear in mind that it doesn't have to be the same employees, right?
Right.
It's sort of employee neutral. So no one is saying you have to keep John, even though John's a bad guy. You could replace John, so long as you're maintaining your payroll overall. There's no commitment to any particular employee.
That's a very good point. Thanks for pointing that out, Gopal. Yeah, it's really about the payroll dollar amount. That's the question, is maintaining that 75% of your payroll dollar amount from origination. So All right, Joanne Oates. I applied for the economic injury loan advance. I do not need more than $10,000. I only need to help pay my lease on my office space. It has been 3 days and I have not received any money yet. Do I call the SBA to follow up? Well, Joanne, you can try. I sat on hold for about 6 hours to get somebody. I will tell you, emailing the SBA is a better way to go. They have an email address specifically for questions and concerns about the EIDL application. I will tell you that advance and that 3-day promise, not very solid. I think it's probably going to run closer to a week to 2 weeks. So you should be prepared to wait anywhere up to the roughly 7 to 14 days after you applied. They're just putting a lot of these loans under scrutiny to make sure that there's not waste, fraud, or abuse happening as the money goes out the door.
And I don't know what state you're in, Joanne, but if the concern is, being evicted from your space, I know, for example, if you were in New York, there's a moratorium on evictions and foreclosure, at least for the next 90 days or so. So your landlord could not, begin to take any kind of enforcement action against you within that period, which would give you enough time to wait to get the funding. But again, that's a state by state thing, and so
All right. Next question from Dion Gordon. Any penalties for early repayment for the 30-year loan? There are no penalties at all for early repayment. Dion, there are no penalties at all for early repayment, and that is one of the benefits of these loan programs. If you take out one of them and your business starts doing really well a year from now, you can pay the entire loan back and not have to worry about it at all. All right, Blondell Pinnock asks, no, that's a thank you to you, Gopal.
Thanks, Blondell.
Sharon Smith, Sharon Smith asked, in the past, it's been rather paper-intensive process to apply for these loans. Is it now easier to apply given the circumstances? I'll speak to the EIDL, and then Gopal, maybe you want to talk about the PPP since you've been doing some of that. The EIDL, like I pointed out in the presentation, takes about 7 minutes. It's really not a hard loan to apply for. It's all online, and it goes pretty quickly, and you'll get your application number. What's hard with the EIDL is that waiting period of it could be 14 days before you hear or see anything.
On the PPP side, it's a similar online process. Again, each bank will be somewhat different, but I don't imagine there's any bank under the current circumstances that is going to force you to actually physically come into a branch or mail them paperwork. So in a typical scenario, it's an online application. You go in, it'll take a little bit more than the 7 minutes or so that the EIDL program will take, but it's a fairly simple application. And depending on your answers to some of the questions, your bank may follow up and ask you for additional information. You'll definitely need to submit information to sort of verify your payroll for the applicable periods. But depending on your answers to some of the questions, they may ask you for additional information. But filling out and actually submitting the application itself, maybe 15 minutes or so, 20 minutes. And depending on your answers, you may have to submit, we'll sort of determine what kind of paperwork you'll have to submit. But the short answer is it's not a document-intensive process for the PPP. It's actually intended to be a lot less so than the EIDL, where you have to go through a credit screening process, which has been eliminated for PPPs to make it easier for you to apply. So short answer is it's not a document-intensive process, certainly not intended to be.
Excellent. The next question, if you are self-employed and have no payroll in 2019 or 2020, but are developing clients, what's the best program? Honestly, I will tell you the EIDL. You're going to go into that. You're going to explain all your circumstances. You're going to get something out of the grant. And that's about it. You can apply for the PPP, but if you have no revenue, right over the last any period, then it's really hard for the banks who are going to want to give you any money or lend to you because you don't have any proof that you've made money. So yeah, I would go to the EIDL if you don't have any. If you were self-employed but have no payroll in 2019 or 2020, the EIDL is your better place to look. Just remember the EIDL is not traditionally forgivable and is a loan, but odds are if you started a brand new business, say on January 15th, odds are you're not going to get approved for the full traditional loan and are going to need to and you're not going to get approved, so you'll get the grant, and whatever portion of that grant will be forgiven as a grant because you couldn't get approved for an EIDL. And then I think our last question is Hai-Ying Lee says, I have a client who's the owner of a shopping strip. He has no employees. His tenants cannot afford to pay rents. What program is best for him? I would recommend he applies for both the PPP and the EIDL. The PPP program will be able to claim himself as a payroll, right, since he has no employees, which will then allow him to pay himself. And the EIDL will actually give him a loan that will cover the lost rents. Now it's a loan, so he's going to have to repay it, but it'll cover the lost rents and allow him to have operating capital to pay whatever his mortgage is on that shopping strip and everything else are. Sorry, Chris, go ahead.
I was going to say, I wasn't sure if you're done. If you have more, please add. We have a couple of questions that came in after we started up at the top.
There you go. Sorry. So you want to ask again, what if you are a startup, restart, and in the process of building business independently, have no payroll, balance sheet, you have not yet earned revenue? Then your only bet is to go to EIDL. Unfortunately, that's sort of the only place to go. If you have no revenue, no payroll, no balance sheet, the EIDL is specifically built for businesses that have no credit worthiness and were hurt in the startup phase of their business. Nangalin Agulo, I have a client that purchased a business here in order to apply for an E2 visa. But since the consulates are closed, his interview was delayed. Now he has many things to cover here, 2 rents, 14 employees, etc. He doesn't have a social security number. Can he apply for any relief? If so, what would be a good idea for him? That's tough. I mean, Gopal, this would fall under, it's a US-based business because he purchased it and it's here. Mm-hmm. And his employees would be US-based employees, I'm assuming, right?
Mm-hmm.
So he could apply for the PPP?
He could apply for the PPP because it started out focusing on whether or not business owners, 20% or more owners, were U.S. citizens or permanent residents. The SBA and Treasury have since revised their guidance to focus on, are your employees U.S.-based employees? And if the answer to that question is yes, then your immigration status as an owner is not going to preclude you from applying for relief under the PPP program.
Yeah. Nandalin, what I would say is contact us at BurgherGray, and we're pretty good at walking through these programs and being a representative and an agent on behalf of these types of clients. And we'd be happy to file the paperwork and do the application and everything and work out that arrangement with you for your client. Charmaine Wall asked if there is forbearance on mortgage, which means I won't have proof of payment for most recent mortgage. Does that present a problem? Charmaine, I'm assuming that you're talking about you run your business from your house, and so you're applying for the tax credit, like, as in your personal home office is your business office, therefore that is your rent portion. If it's more of,
or possibly she runs a business that owns the building.
yeah, if the business owns the building and you have a mortgage, and that's what I was getting into, your mortgage servicer should still be sending you a mortgage statement, because depending on your state, some states the interest is frozen during forbearance, other states it isn't. So your mortgage servicer still has to send you a statement even during forbearance. So you'll receive a statement every month. Now, what we don't know, and what I'm assuming the SBA is going to look for, is if you're under forbearance, then that money that's not paid to rent is not forgivable. And in some states, the forbearance guidelines get wonky.
So one of the things that she should consider here, Gaurav, is that although your loan may be in forbearance, you still owe the money. At some point, forbearance period will end, and you will have to pay that money. So the mortgage payments that are in forbearance, you could use your PPP funds to pay those money, to pay those mortgage payments. And because your loan is in forbearance, you can always make a mortgage payment at any time you want. A forbearance just gives you the option not to do it before the forbearance period is over. So just bear that in mind. That's
exactly what I was going to get to. Was most states are allowing you to continue making payments during the forbearance period. So I think that's all of them, all the questions that we had that I saw. I think that covers everything, unless anyone else has got a question.
We're right about at the 3:15 mark, so I think that's a good, if folks still have questions, you can always reach out to your BurgherGray contact. And if you don't have one, feel free to give us a call, 636-513-43. What's our number? 646-513-3231, or BurgherGray.com, BurgherGray.com. We'll be happy to answer your questions offline and help you as appropriate to navigate what can be a very complex and confusing set of rules.
And we want to thank everyone for joining our presentation. We appreciate you taking your time and allowing us to present this material to you.
Yes, thank you very much.
Thank you.
All right, thanks everyone.
Thank you, everyone.
All right, Matt, I think we can close it down.